Welcome back to another Deep Dive Explainer. Today, we are uncovering a massive macroeconomic shift that's been hiding right in plain sight. Get this. New data shows that married people have an 83% lower cancer risk, along with significantly higher economic stability. Now, I want to be super clear right up front. This isn't just a lifestyle observation, and it's certainly not a dating tip. It is a $10 trillion investment theme. We call it the marriage premium. We're going to explore exactly how who you live with is fundamentally rewriting actuarial science and defining the very future of the longevity economy. So let's get into it.
Here is our roadmap for today's deep dive. We're going to start with the $10 trillion secret variable, then move into demographics, risk, and time. After that, we'll unpack the brutal single tax, explore biological alpha, look at institutional plays from giants like UHG and ELV, and finally, break down the shift to life cycle investing.
All right, Section 1, the $10 trillion secret variable. Let's uncover the demographic data that is really driving markets right now.
For the longest time, the investment world has been completely obsessed with traditional stocks-only growth. But right now, we're witnessing a massive fundamental pivot into what we call demographic economics. And to truly grasp this $10 trillion longevity market, which, by the way, is effectively the world's third largest economy, we have to start with a truly staggering clinical data point: 83%. A landmark oncology study recently highlighted in the Wall Street Journal and Cancer Research Communications analyzed over 4 million cases, and it revealed something absolutely incredible. Never-married women face an 83 to 85% higher risk of cancer incidence compared to their ever-married counterparts. And for never-married men, it's a 68 to 70% higher risk. This isn't some minor statistical anomaly, you guys. It is a glaring, undeniable divergence in biological resilience.
And this massive paradigm shift absolutely demands our attention. Like the quote says, this isn't a dating tip. It's a $10 trillion investment theme. You might be wondering why. Well, it's because massive insurance conglomerates and healthcare providers look at that specific biological resilience and they see a uniquely predictable high-value asset class. Health stability directly correlates to wealth retention, and these massive capital allocators are literally building multi-decade financial models around this exact divergence.
So that brings us to our core thesis for today: the marriage premium. When we really understand this concept, we reframe household structure entirely. It goes from being just a societal norm or a casual cultural observation to the ultimate stress-tested economic variable. Think of a marriage like a corporate merger. You've got two balance sheets combining to weather market volatility. This premium actually predicts who is going to retain capital, who will survive health shocks, and who is ultimately going to drive the economics of aging for the next 50 years.
Moving right along to Section 2, demographics, risk, and time. These really are the fundamental equations of the future. To understand exactly how massive healthcare entities price risk, we have to look at the undeniable relationship between aging populations and the passage of time. Forecasters use a pretty simple formula. Policy applied to demographics equals the future. When we factor in time, we have to consider the Lindy effect. That's the idea that time is the ultimate stressor, and things that can survive time are inherently robust. Now, apply this to household wealth. Single-person wealth is kind of like an options contract facing rapid time decay. Single individuals face incredibly steep longevity risks. That's the terrifying mathematical danger of completely outliving your assets as healthcare and housing costs continue to skyrocket. Joint wealth, on the other hand, it has built-in structural buffers, shared resources, and overlapping safety nets designed to survive the stress test of decades.
Which leads us to Section 3, the brutal single tax and the everyday economics of shared costs.
We really need to understand the financial drain experienced by the fastest-growing demographic globally, the single-person household. Because despite this rapid growth, single households have the absolute lowest wealth retention rates. This is the brutal truth of the single tax. Single individuals suffer a massive 168.7% economic disadvantage in per capita housing and utility costs alone. Overall, their total fixed load eats up a huge 28% of their budget, compared to just 18% for a nuclear family. Simply put, there are zero economies of scale when you live alone. You literally can't split the rent, you can't split the internet bill, and you definitely can't split the sudden, panic-inducing cost of a broken water heater. It is a 100% burden 100% of the time.
And when you play that single tax out over a couple of decades, the long-term compounding results are pretty staggering. Just look at the average pre-retirement assets for adults in their 50s. Because single individuals bear 100% of their fixed costs week after week, year after year, they really struggle to generate any surplus capital to invest. They sit at around $167,000 in assets. Meanwhile, stably married couples who have been compounding their shared surplus for years have amassed over $640,000. That is a staggering fourfold asset gap right when people are preparing to enter the longevity economy.
All right, Section 4, Biological Alpha. Let's look at how human longevity risk is actually priced in the real world. Going back to that clinical oncology data we talked about earlier, we can clearly see how financial stability perfectly merges with physical health. This is what we call true biological alpha. Take colorectal cancer, for example. The risk is literally 2 to 5 times higher for never married individuals. Why is that? Well, it's because spouses act as informal healthcare coordinators. It's usually the spouse who notices a lingering cough, right? Or who nags you to go get that weird mole checked out, or who ensures you actually stick to a complex medication schedule. This shared daily household vigilance drastically lowers per capita treatment costs because it catches critical health issues early, long before they require catastrophic, wildly expensive medical intervention.
And this dynamic perfectly illustrates why modern insurance actuaries have completely evolved their game. They no longer rely solely on those traditional individual mortality tables. Instead, they're using highly advanced multi-state Markov models. In plain English, these joint life models mathematically account for spousal interdependency. They are literally pricing in the fact that couples keep each other alive, and they also account for the widowhood effect, which is the statistical reality that the mortality risk of one spouse severely spikes after the passing of the other. So risk is now being fundamentally priced based on relationships, not just pure biology.
Let's dive into Section 5, Institutional Place, how the big players are profiting from the longevity economy. Which brings us to the multi-trillion-dollar question. If you are a massive institution operating in the longevity economy, how exactly do you capitalize on this demographic data? Make no mistake, healthcare titans are not just passive observers of this demographic shift. They are actively building their entire corporate strategies, their risk models, and their long-term profit centers around these exact biological and financial statistics. Just look at industry leaders like United Health Group and Elevance Health. They aggressively target married cohorts for what's called value-based care. This is a massive paradigm shift from traditional sick care over to prevention and wellness. Why? Because married couples are incredibly receptive to in-home health risk assessments, which maximizes Medicare Advantage risk models. But most importantly, married couples have the built-in 24/7 support system to successfully age in place at home. Think about it. A single person who suffers a fall often ends up in a highly expensive nursing facility. But a married person, they recover at home under the watch of their partner. That one difference reduces government Medicare spending by an astonishing 420%. It is a massive, massive win for institutional profit margins.
Finally, Section 6, the shift to life cycle investing and rebalancing human capital.
So what does this all mean for you and your own portfolio? To really capitalize on these macro trends, individual wealth management has to completely abandon outdated, one-size-fits-all frameworks. We call the solution life cycle investing. Step 1 is treating your household's human capital, meaning your future lifetime earnings, as an actual tradable asset on your balance sheet. When you do this, a stable marriage with 2 potential incomes functions almost like a massive risk-free bond. If one spouse loses a job or faces a temporary health shock, the other's labor supply acts as a powerful financial buffer. This allows the household to confidently take on more calculated, higher-yield risks elsewhere in their portfolio.
And this concept completely rewrites the traditional allocation glide path. A young married couple, say aged 25 to 35, can comfortably hold 90 to 100% in equities because their spousal labor supply protects them from a total income shock. But compare that to a single individual entering retirement. They entirely lack this human capital buffer. Because of that brutal single tax and the heightened longevity risks we discussed earlier, they are often forced into heavily conservative, low-yield portfolio allocations of just 15 to 25% equity. They have to do this simply to survive potential health and labor shocks without going completely bankrupt. The demographic reality literally dictates the investment strategy.
As we wrap up today's explainer, I want to leave you with a question to really chew on. As we all navigate this $10 trillion shift, ask yourself, is your portfolio built strictly for outdated equity growth, or is it genuinely optimized for the demographic reality of the longevity economy? The data undeniably proves that your health, your wealth, and your household structure are permanently and mathematically linked. Thank you so much for joining me on this deep dive. I highly encourage you to go take a look at your own balance sheet and your life through the lens of the marriage premium. See you next time.